Imagine turning £100 into 1,000 in just a few months. Your neighbours are getting rich, your barber owns shares, your servants are borrowing money to invest, even members of parliament are buying in. Then, in a matter of weeks, everything disappears. Homes are lost, fortunes evaporate, banks collapse, lives are ruined. This was not Wall Street, this was not the Great Depression. This happened over 300 years ago, in one of history's first great financial crises. By 1720, Britain had become one of Europe's rising powers, but success came with a problem. War was expensive. Decades of conflict against France and Spain had left the British government drowning in debt. The government owed investors millions of pounds, an astronomical sum for the time. Finding a way to deal with that debt would lead to one of history's greatest financial disasters. And at the centre of it all was a company promising unimaginable riches from lands that hardly traded with Britain at all. In 1711, a new company was created, the South Sea Company. Its purpose seemed ingenious. Instead of the government owing money to thousands of creditors, those creditors could swap their government bonds for shares in this new company. In return, the company would receive interest payments from the government. Everyone appeared to win. The government simplified its debts, investors received shares instead of bonds, the company gained a guaranteed income. But there was one extra promise. The South Sea Company claimed it would be incredibly wealthy through its trade with Spanish South America. Gold, silver, sugar, slaves. An entire continent seemed ready to generate limitless profits. There was just one problem. Britain was still largely at war with Spain. The company had almost no meaningful access to those markets. Its grand trading empire existed mostly in imagination. By 1720, the company's directors had a bold proposal. Why stop with part of the national debt? Why not absorb almost all of it? The government agreed, Parliament approved. Suddenly, the South Sea Company looked unstoppable. The share price began climbing, 100, 200, 300 pounds. People couldn't believe how quickly fortunes were being made. Every rise convinced more people to buy. Newspapers praised the company. Coffee houses buzzed with rumours. Friends convinced friends. Families pooled savings. Nobody wanted to miss the opportunity of a lifetime. The higher prices climbed, the more people believed they could never fall. Speculation spread across Britain like wildfire. Doctors invested, lawyers, merchants, members of the aristocracy invested. Even Sir Isaac Newton, one of the greatest scientific minds in history, bought shares. At first, Newton made a hefty profit. He sold his holdings, then he watched everyone else continue getting richer. Unable to resist, he bought it back in, this time at a much higher price. It would become one of history's most famous investment mistakes. Meanwhile, hundreds of new companies appeared overnight. Some promised to manufacture impossible inventions, others claimed to discover miraculous technologies. One company famously advertised itself as a company for carrying out an undertaking of great advantage. But nobody knew what it was. People invested anyway. The fear of missing out completely replaced common sense. By that summer of 1720, the South Sea Company's shares approached £1,000, a tenfold increase in less than a year. On paper, fortunes worth millions had been created. Luxury spending exploded. Country estates changed hands, servants became investors. Ordinary families believed they had found permanent wealth. But underneath the excitement, almost nothing had changed. The company still generated very little real trade. Its profits could never justify the enormous valuation. The market wasn't buying earnings, it was buying hope. Then, confidence cracked. Some investors quietly began selling. Prices started to slip. Others then panicked. More selling followed. Within weeks, the share price collapsed. Hundreds, then thousands, then tens of thousands of investors watched their wealth disappear. People who had borrowed heavily were completely ruined. Businesses failed, banks struggled, families lost everything. The richest company in Britain had become one of its greatest disasters. Sir Isaac Newton reportedly summed it up perfectly. I can calculate the motion of the heavenly bodies, but not the madness of people. The public outrage was immense. Parliament launched investigations. Directors were accused of bribery, corruption, and manipulating the market. Many had secretly enriched themselves while encouraging others to buy. Several fortunes were confiscated. Politicians were disgraced. The scandal reshaped Britain's financial system for generations. Although markets eventually recovered, the South Sea bubble became a permanent warning about speculation. It's tempting to think people in 1720 were simply naive. But human psychology hasn't changed. Whether it's railway shares, dot-com companies, housing booms, cryptocurrency, meme stocks. The pattern is remarkably familiar. A new opportunity appears. Early investors make incredible profits. Everyone rushes in. Prices become disconnected from reality. Then someone blinks. And the bubble bursts. This wasn't just Britain's first great stock market crash. It revealed something timeless about human nature. Greed, hope, fear of missing out, and the dangerous belief that this time is different. If you enjoyed this journey into financial history, subscribe for the next episode in our series, where we will uncover another spectacular boom and bust that changed the world forever. Because history doesn't repeat itself, but it often rhymes.